Yeah, said bluntly, I needed the money right away. So I needed to walk into something and have a paycheck right away. But especially with AI now and the ability to just crank software with Cloud Code and everything else, buying an existing customer base and existing business with distribution, for me anyway, is a smart way to go. That is definitely the way to go, at least for me.
Welcome to Frank Growth. I'm Jason Shafton, and I run growth consulting firm Winston Francois. Around here, we tell the truth about growing, the good, the bad, and the you can't say it out loud ugly. Every episode, we get tactical with operators, investors, and builders, what works, what breaks, and what to do next. No fluff, no vanity metrics, no hustle theater, just signal. This is Frank Growth. Let's get into it. Today, we've got Doug Breaker. Buy a SaaS, skip the startup. Before we bring Doug in, here's a quick riff on today's topic. Everyone talks about building. Almost nobody talks about buying. But here's the math most operators never run. You can acquire a profitable running software company with customers, revenue, and a team using an SBA loan, that's a small business administration loan, and as little as 5% down. No fundraising, no 2-year build phase, no 0 to 1 risk. Here are 3 things I see operators get wrong about this path. 1, they romanticize starting from zero. Building is hard. Buying something that already works and making it better is a different and often smarter kind of hard. 2, they don't know the financing exists. SBA loans for software acquisitions are real, accessible, and dramatically underused by operators who could qualify. 3, they wait for permission. The corporate ladder feels safe until it doesn't. The best time to buy was yesterday. The second best time is today. That's the frame we'll use today with Doug, a 4-time CEO who just walked away from an 8-figure company to buy his own 7-figure SaaS with just a little bit down. Let's get tactical. Doug, welcome to Frank Growth.
Thank you so much for having me. Excited to be here.
You've been a CEO for hire, is it 4 times?
4 times for hire, and then I just bought Shoeboxed a couple months ago.
Yeah, and before that you were running MD Hearing Aid, which is like an 8-figure D2C business, right?
Yeah, MD Hearing Aid was the largest D2C seller of OTC hearing aids in the US. So I can't disclose actual revenue, but between 10 and 100 million.
There you go, 8 figures.
Yeah.
And now you've done something that a lot of operators dream about, but people don't pull the trigger on this one. You bought your own software company, right?
I did, yeah. I bought Shoeboxed, which is like a 20-year-old SaaS company that helps small, medium business save money on taxes.
Amazing.
Yeah, it was fun.
Before we get into the how and like the whole story to get there, tell me what made you finally say, I need to own the thing myself.
Yeah, 2 reasons. 1, I wanted to own something since I was like 5 years old, no doubt. Second is being a CEO is a little risky. So I had been asked to leave at least one CEO job, and I just wanted to control my destiny and take the upside for myself and have a flexibility. So when the chance presented itself, I jumped.
Nice. Why buy a SaaS instead of building one from scratch? Like, what's the math that made acquisition the smart play for you?
Yeah, said bluntly, I needed the money right away. So I needed to walk into something and have a paycheck right away. But especially with AI now and the ability to just crank software with Cloud Code and everything else, buying an existing customer base and existing business with distribution, for me anyway, is a smart way to go. That is definitely the way to go, at least for me. But just the last month or 2, man, it's crazy. Like Cloud Code can do
the pace at
anything.
which things are changing, for sure.
Yeah, for sure.
So walk us through the sourcing process. How did you find Shoeboxed? How many deals did you look at before you landed on it?
Yeah, Shoebox is a bit unique because I bought it from a friend, but I had looked at hundreds, if not thousands, of deals over the last 10 years. I've always on BizBuySell, Acquire.com, on Flippa, Fee International, all the different brokerages. I bought 4 or 5 different companies as when I was in my different CEO jobs. So I looked at hundreds of deals. This one turned out, a buddy owned it and he didn't want to do much with it. And it just fit perfectly with what I wanted. Huge customer base, been around a long time, a problem that I really love. So yeah, it just worked out.
Let's get specific on the deal structure. I think the details are like $1.5 million revenue, and you bought it with an SBA loan, 5% down. How does that actually work, and what do most people not understand about the whole SBA acquisition game?
Yeah, if you think about it like buying a house, it's a little bit similar. Think about the SBA as just like a mortgage broker. What they're looking for is to make loans where they're really confident they can make their money back. And the SBA will loan up to 90%. The way I structured mine was I had the SBA loan do 80%.
Mm.
And then the seller did 10% seller financing. So, wrote his own loan. And then I threw down 5%. And there's a little rule in the SBA where if the seller puts in seller financing, some of that can count as your equity. So
Mm.
the way that I bought it was only 5% down. But what the SBA cares about is cash flow. So they want to make sure they're getting paid back. So what they do is they look at 3 years of tax returns, you as a person, your assets, your capabilities, your history, and then they make a call on like, hey, is this person going to be able to take over and then pay us back?
Yeah. And you're like personally guaranteeing it, right?
Yeah, no,
Yeah.
that's the part that takes your breath away a little bit is
Yeah.
you have to put up your assets. So you have to be sure.
Yeah. And I imagine that due diligence on a 20-year-old software company was interesting, especially if it's a friend that kind of started it and owned it. What mattered most? And was there a moment that maybe almost killed the deal?
Yeah, Jason, we talked about before about like Claude Code now.
Yeah.
This was like call it 6 months ago, but in any business, what you want to buy or what I'm really interested in is do they have a really great way to go acquire customers and keep customers with something that people really want? And so I look for history, I look for distribution. And so in Shoebox's case, the email list is over 1 million people. We've got to warm that up again. But the domain has great ratings, so it'll rank in SEO and in different chatbots. It's a problem that's not going away. So the diligence was less on the tech side because I'm comfy there, and more like, hey, is the customer acquisition piece strong and stable, and is that
Is
going to
this a
stay?
sustainable business that's gonna stick around?
Exactly. Yeah, definitely.
So it's been running for 2 decades, I think 10-person team. What does day one look like when you acquire the company that's been operating, without you for decades?
Yeah, it's crazy. So I've dropped into my other CEO jobs. I've dropped into all of those. 3 of them were brand new companies. So day
Mhm.
one was like the day you meet everybody.
Yeah.
That first day, you just want to have people relax a little bit and take a breath and really over communicate what you're going to do. And hopefully through the diligence process, you've comfortable with the financials and the tech stack and the marketing and everything else. But that day one is really solidifying the people piece of it to say, you know what, you guys, do you have jobs? Or if you're going to make changes, say what those changes are, but really let everybody take a breath and understand what the next week, the next month, the next year is going to look like.
Yeah. When you were looking at it, and it sounds like you did, more diligence on the business side than the technical side, I assume you wanted to kind of make sure that the future growth looked good. What signals were there that told you there's a lot of upside and, that this wasn't something that was going to flatline once you bought it or decline?
Yeah, great question. So in Shoebox case specifically, they had not really done marketing in 4 or 5 years, but they had great assets, like great bones, if you will. So the email list was huge. They weren't sending emails. The SEO power of the website, which also translates to like ChatGPT and the other chatbots, was
Hmm.
huge, and they weren't doing that very well. They hadn't really thought about product or pricing in a while. And then there were competitors in a really close space, which is mileage tracking, that were making 10 or 20 times as much as Shoeboxed. So with a little, product tweak and tech tweak, some marketing stuff, and just doing the things, the basics, the risk was really low for growth and for profitability.
Nice. You just came from running an 8-figure annual kind of D2C marketing budget at your last gig, MD Hearing Aid. How does the operator lens change when you're looking at a business that's, a fraction of the size, much smaller resources? Like, how are you thinking about this kind of marketing piece now with Shoebox?
It was great training, I'll tell you that. We spent well over $10 million a year, and hearing aids in our market were a commodity. Everybody could source
Competing on
basically
price.
the same things. The same thing is happening with software now. Mentioned a couple times, but now anybody can write software or apps.
Right.
So it's really, how do you go get customers? How do you present your value to them? How do you get them on board? How do you keep them? It's everything around the tech and kind of the product, because the product cost is really kind of going to zero. So it's interesting though, because it opens up a whole new world of like growth through acquisition, because the
Yeah.
tech risk is really gone.
Yeah.
Because you can just tell Claude Code, like, hey, rewrite this for me. Going to buy customers and buying distribution is now more possible than ever.
Yeah. What's fundamentally different about growing a business that you own 100% versus growing one where you're the hired gun CEO?
Yeah, I think 2 things. One, the pressure and the expectation, and then the reward. So I remember at Earth Class Mail many years ago, we were growing 30% year over year profitably. And I was like, we're doing an amazing job. And the PE owners were like, no, you're not doing an amazing job. You suck. We need 50%. And I was like, that doesn't feel good. Personally, if you grow 30% year over year, profitably, like that's great, right? So that's one. And then two, when you're a hired gun, you might have stock options, you might have a little bit of ownership. When you own it, you own it. And there's like great tax benefits to owning, and you can get a lot of the gains tax free. And I don't know, it's yours, so you own it. It's great.
All right. So at MD Hearing Aid, you ran pay for performance TV with Joe Namath
Yeah.
at a very high fixed cost per 60-second call.
Yeah.
What did that teach you about direct to consumer economics that then translates to SaaS now?
That was crazy. Like you go, you work with these performance TV agencies, and they'll say, okay, we'll cover the cost of the shoot, but you pay us, $100 per call or whatever it is. That wasn't the number. But then you have to like convert. You have to have the call centers that answer the phone all the time, and you have to convert at 50% to make the money work. But what I learned is if you get that right, and this applies across different channels, but if you get that right, it can really drive growth. But you have to have each piece of that funnel correct and your tracking really correct. But man, is the world big when you can crack that. And you can do it on Facebook and TV. TV is a little bit harder, but it's a really fun ride, but it's not for the faint of heart.
What would you say are the growth fundamentals that stay constant regardless of the business model?
Yeah, it sounds really basic, but you have to figure out the customer acquisition piece early. And then offering somebody something that some people like actually want and will pay for is key.
Important.
I've done a lot of like my own little stupid ideas where it's like something that nobody wants, and that's not fun. Or you choose a market that's like so small that even if you win, it's not going to matter so much. Like my first company was pickleofthemonth.com. So not that many people want pickles every month, right? Versus if you sell something like leads to real estate agents, that was Home Finder. Lots of people want that. There's a million real estate agents.
Yeah.
It sounds really basic, but like figuring out profitable customer acquisition for something that people actually want and will pay for long term. What I learned at MD Hearing is you choose a market and a problem where what you do better actually matters. So there it was like customer service. Like customer service really mattered there, and we loved doing it. Versus, some markets may not reward things that you really want to do. So you gotta look in the mirror at the end of the day too.
What's the biggest operational risk when you buy a small SaaS, and how are you mitigating it? How did you mitigate it, kind of first 90 days?
Yeah, for a SaaS, if it's a stable SaaS, like the customer base is going to be there.
Mhm.
As long as you don't mess up billing. So you got to make sure that the money's coming in and money's coming out, and like all of that stuff you normally do. For a small SaaS, people is like the number one thing you have to pay attention to. So you have to make sure that the trains keep moving, that your key employees are good, they're stable, that they're going to be there. If there's a technical founder or a CTO, you need to make sure that that person's going to be there if things break, because they always break, and they'll break right when you buy them. So it's really the people. That first 90 days is just getting to stable, okay, everybody can breathe now.
You started your career as a developer and you still code. How does being technical change the way you evaluate and operate a software acquisition?
I'll tell you, Jason, it's changed in the last month.
Maybe give me the pre-AI answer and then the post-AI answer.
Yeah. So for Shoeboxed specifically, when I bought, my thought process is like, well, I can go hire, an app developer, and going to go hire these different people to replace our tech and to upgrade it where we need upgrading. Now, in the last month, I just rewrote our apps myself without touching a line of code. I just told Claude Code what to do, and then I know enough frameworks and structure to have it do it correctly. But you still need to have that technical background, whether it's as a developer or product manager or project manager, something to let you use the tools correctly. But it's completely changed. I won't lie. It's crazy.
So for operators that are listening who are thinking about buying instead of building, what's the realistic capital stack? What should they have saved or lined up before they start looking?
It's really up to the person. So for me, I have 4 kids. I'm 50. I've got one in college. There was no chance of me not having to take a good salary. Versus me at 20, I could live for a couple years off savings, for example. So it really depends, but look at your cash flow needs, look at how much of a company you want to buy, and then back into it. What the SBA is going to look at, or what other lenders are going to look at if you're taking debt, is cash flow. So you need to identify cash flow even more than revenue or costs or anything else. They're going to look at cash flow. But it really depends on your situation.
Yeah. Okay. When you were negotiating with this buddy of yours to kind of buy it, Was there a specific thing that was the hardest part of negotiating? I mean, I can imagine if someone's a friend, like maybe you treat them differently than a person you found on acquire.com. So how did that negotiation work?
Yeah, I've been through a bunch of failed ones before and a couple of successful ones. So I've learned the hard lessons. What I've learned over the years is to make it a very easy yes for, in this case, the seller. His name's Jonathan. I was like, Jonathan, I'll make it super easy for you. You get this much cash at close. I'm going to take over the tech day one and the company. Just need a little bit of help from you. So I've learned over the years, the easier make it for the person to say yes while covering your own risk, the higher chance you have of actually getting it done.
I feel like that's a common sales tactic as well.
Yeah,
The
it is.
easy
It's so
method,
true.
and then you give them the hard one, and then it's easier to get a yes to it.
Yeah, for sure.
Walk me through that SBA loan process timeline, like from, the start to actually, the wire hitting and you're being able to kind of fund and close the deal. How long did that take?
Yeah, for me, it was about 3 months.
Wow.
And I had already agreed on the basics of the LOI with
Mhm.
the seller,
Mhm.
but it takes about 3 months because the SBA requires a lot of documentation. So you have to get everything, it seems like.
Yeah.
And then in the middle, my one bank switched banks, like the main broker switched banks. So there was some nonsense there. And then they didn't, right at the end, it was a funny story. They didn't tell me it had to be an in-person notary. So we were going on vacation. I thought I could do an online notary. So that delayed things a week. But about 3 months is like the right kind of rule of thumb. It was like we were ready to go with all the deal specifics. And then it took 3 months. So we
Got
had
it.
already done the negotiating,
All
all of
that
that.
pre-work
Yeah.
and diligence had really happened.
Yeah, exactly.
How do you earn trust with an inherited team that's kind of been doing things their way for years? And you come in, you're technical enough, and here you are with Claude Code, and you guys are starting to rewrite code base. Like,
Yeah.
what was that like, and how did you kind of get the team to say, okay, we got it, we trust you?
Yeah, for Shoebox particularly, they had been through like 4 owners or 3 owners in 5 years. So they were pretty battered in terms of like who to trust and is this guy for real? So the number one thing was really like being open and honest with them to say, hey, I'm buying this company personally. Like this is what I want to do for the next 5 years, maybe more. I don't have any plans to sell. I'm going to be here. Here's what you can expect from me. So again, it's like management 101 a little bit, but like being really open and honest and clear with expectations of, yes, like I care about you. I care about this company. Here's how things are going to roll. Here's what I expect from you. Here's what you can expect from me. Here's everything that we're going to do with the company. And once people get an understanding of that, uh, then I've found as CEO this many times, like then they get on board pretty quickly.
When you acquire a mature product like this, how do you separate technical debt that doesn't matter from the technical debt that will slow you down and stop you from growing?
Great question. I always come back to what will people pay for? I'm a big fan of Basecamp, the company, and their kind of product philosophy. And it's like keep taking stuff away until people complain. That sounds harsh. Or
Mhm.
only add things if people are willing to pay for it. And we did the same thing at MD Hearing of like different features for hearing aids, which are much harder because there's a hardware cycle there. So we do some testing to put up landing pages to see what really performed better in an ad, basically, and what had a better conversion rate. Same type of thing with tech debt to say, how much can we rip out? How much can we simplify? And what do people really care about? And so you do that with talking to customer service, talking to customers, talking to the looking at logs, like all that stuff. But it's really like, what's the minimum we can offer that actually people will pay for?
Yeah. All right, let's do a lightning round. So quick questions, quick answers. One metric you look at every week as a new owner that you never cared about as a hired CEO.
Cash in the bank,
First marketing dollar you're spending at Shoeboxed. Where is it going?
SEO.
One tool or resource that was indispensable during the acquisition process.
I'd say barometrics,
Like it. Biggest misconception people have about SBA loans.
that they're hard to get.
One thing that you'd tell your 35-year-old self about the path to ownership.
Do it before you're ready, in my case.
I like it.
Yeah.
All right. Last question. This is not a lightning round question, so feel free to take your time. For the person that's listening who wants to exit the corporate world and own a small software company like what you've done, but maybe they're gun shy, they don't want to pull the trigger yet. What's the one thing you'd tell them?
Do it on the side. Go onto Flippa, go onto Acquire, Biz by Sell, wherever, and try it. Try it in a risk-free way and see if you have the energy to do it. See if you like doing it. You're going to learn a ton without burning the ships. And there's things small enough where you can do that. I mentioned pickleofthemonth.com before.
Is it available for sale?
That was my first go, but I had my developer job still. Like there was no risk there, right? Of like my employer being mad, they just laughed at me. But it taught me so much. It taught me a ton, and it taught me that I like this stuff. So I'd say go try it and see how it is
I think it's
before you
good
fully
advice.
jump in.
Doug, this was very specific, actionable, exactly why I do this show. So thank you. Where can people find you online? Any kind of promo or anything you want to plug for Shoebox?
Yeah, the easiest place to find me personally is LinkedIn. So just look me up. If you want to reach out to me at Shoebox, it's doug@team.shoebox.com. Shoot me a note, and I'd love to give you a good deal.
Oh, that's awesome. Well, we'll include all that in the show notes. Just grateful that you were able to come on and hang out with us today. So thanks for being here.
Thanks so much, Jason.
That was Doug Breaker, and a real map for buying your way into ownership instead of building from zero. Here are my quick top 3 from today. Remember these if you remember nothing else. 1. Distribution is the asset, not the tech. With AI collapsing the cost of building software to near zero, what you're really buying is customers, domain authority, and distribution. Doug didn't buy Shoeboxed for the code. He bought a 1,000,000-person email list, a high-authority domain, and a problem that isn't going away. Evaluate acquisitions through that lens. 2. SBA loans are easier than you think, but they care about one thing: cash flow. Doug bought a profitable SaaS with just 5% down. The SBA kind of works like a mortgage. 3 years of tax returns, a personal guarantee, proof the business cash flows enough to pay them back. Seller financing can even count toward your equity. Most operators don't pursue this path because they assume they won't qualify. The biggest misconception, in Doug's words, that they're hard to get. 3. Ownership means less pressure and more upside, but you have to jump. As a hired CEO, Doug grew a company 30% year over year profitably and got told that he wasn't doing enough. When you own it, you set the bar, you keep the gains, and you control your destiny. The trade-off is the personal guarantee and the risk. But as Doug put it, do it before you're ready. All right, if there's one action item I can give you this week that takes 10 minutes or less, go on acquire.com, BizBuySell, or Flippa, and spend 10 minutes browsing profitable SaaS companies for sale. Don't filter, don't overthink, just look. See what's out there, what the multipliers look like, and start training your eye. Doug looked at hundreds of deals over 10 years before he found the right one. Start the clock now. That's Frank Growth. If this gave you something you can use this week, follow the show and share it with an operator or founder who needs it. I'm Jason Shafton from Winston Francois. We help tech companies build sustainable, repeatable growth with a proven operating system. The show notes and takeaways are in the description. Be frank and keep growing.